Module 5.5 introduces the arithmetic Brownian motion option valuation model. Again, this is atypical. Normally in undergraduate and master's level classes, when covering option price theory or option valuation theory, GBM is focused on exclusively. But I have found this particular model to be useful in a wide array of different applications. And so we're going to review some of the assumptions of the arithmetic Brownian motion version. We'll remind you of the role of dividends. We'll look at different representations of ABM, OVM. We'll actually derive it, review some selected plots, but our main focus in this particular presentation is to compare and contrast GBM with ABM. And I want to emphasize, although I really like ABM, the goal here is not to persuade you to use one model over the other. The goal is to try to convince you that as a quantitative financial analyst, it's good to have multiple models in your arsenal, just in case life presents itself with some unusual circumstances that renders your existing model irrelevant or broken. For example, in West Texas Intermediate crude, nearby futures prices went negative. All the GBM-based option valuation models blew up. And so having ABM laying around that can easily handle negative prices, would have been very useful for many organizations. So the central finance concepts is ABM or GBM. We'll contrast them, look at some history, look at the Black-Scholes-Merton, some of the key issues. We'll explore some empirical evidence. And one of the key complaints of ABM is it admits zero and negative stock prices. And it does, in fact, do that. And we'll look at that very carefully. GBM is deeply embedded in practice. I've actually presented some of these results at academic conferences, and some of my academic colleagues were stunned, as if I were a religious heretic, that I would possibly present something other than the orthodox Black-Scholes-Merton model. And so, but GBM is in fact deeply flawed. Remember, the terminal distribution is assumed to be log normal. Well, if two stocks have a terminal distribution of log normal, when they add the two stocks together, it's extremely difficult to track what that distribution is. Once you get above two stocks, it's completely intractable. So one major complaint against the log normal distribution-based models is the inability to roll up and roll down among individual positions and portfolios. Further, the probability that a stock price actually equals zero is zero under the log normal distribution. Well, unfortunately, stocks do in fact hit zero, absorb at zero, never come off of zero when they often coming out of bankruptcy when the equity holders get nothing. ABM easily addresses these GBM flaws. Normal distribution, as you most likely know, is a sum of log normally distributed random variables is itself log normally distributed. A weakness of ABM is that the probability that the stock price is less than zero is in fact positive. And that is, in my mind, easily handled with a zero strike put option. Limited liability that corporations enjoy is in fact a zero strike put. By way of some history, the first known continuous time option valuation model is Louis Batcheler's model that was published in 1900. His doctoral dissertation on the theory of speculation. He assumed arithmetic Brownian motion with arithmetic drift, and which is often a complaint as people compare geometric Brownian motion option valuation model with geometric drift to Batcheler's model, and that's just an unfair comparison, as ABMOVM can easily have a geometric drift. Cruzinga in 1952 laid the foundations for delta hedging, the self-financing dynamic replicating concepts. And in that particular article, he provides empirical support for ABM. Osborne in 1959, in a detailed statistical analysis, could have supported either ABM or GBM, gave early support for GBM, but that particular statistical study was deeply flawed. He looked at the cross-sectional price distribution on a given day across multiple stocks. That says nothing about the terminal distribution. Sprinkle in 1961 argues negative stock prices is unwarranted, hence he leans towards GBM. Alexander, same year, noted fat tails overshadows any need to distinguish between ABM or GBM. Bonas in 1964 had an early GBM model, but it was really Paul Samuelson in 1965. As best I can tell, he coined the phrase geometric Brownian motion, and he made the arguments that call options can't violate their upper bound. We'll look at an illustration later where a call option is worth more than the underlying stock under ABM, and he found that, Samuelson found that's just unwarranted. But there are ways to easily handle that to make it more in compliance with modern financial markets. 1972, 1973, Black & Scholes published a couple papers. Their 72 paper was actually an empirical study of their 73 model. They introduced continuous rebalancing, did not require risk adjustment, which some of the earlier models we covered did. But they noted some overpriced high variance stocks and underpriced low variance stocks. Interestingly, the ABM model partially could have possibly performed much better in their empirical test had they tested it. Merton, in the same year of 1973, published a paper in the RAND Journal. He introduced rational boundaries, which we covered extensively, and he provided the partial differential equation solution. He basically noted that the Black-Scholes-Merton PDE was isomorphic to a heat transfer equation and based on a guy named McKean, and provided a much more robust theoretical foundation for the Black-Scholes-Merton model. Well, there's several different issues to address when considering ABM versus GBM. Well, one is this issue of zero value. Remember, GBM does not admit zero, and the bankruptcy rate is about 0.7% per year of stocks. Many underlying instruments can and do have negative values. Interest rates go negative. Many spreads, the crack spread, the spread between refined petroleum and its underlying products, and its underlying crude oil, the crush spread, soybeans versus meal and oil, and there's various other bases that can often go negative. And there are options on these spreads. Measurement data such as temperature data can obviously go negative. And one interesting sidebar in Batzelier's day, where he did his doctoral dissertation in Paris, France, the option could have actually negative strike prices. And back then, companies did not enjoy limited liability. Common stocks, this zero issue, an unincorporated asset can easily go negative, and we can look at an incorporated asset as an unincorporated asset plus a zero strike put option. ABMOVM handles negative values easily. We can estimate the probability of zero or below, and we can quantify the economic value of limited liability. Many major companies like Walmart and banks like Citigroup will have thousands of separate legally incorporated entities. Every Walmart store, my understanding, is a separate legally incorporated entity. And in some sense, what they're trying to do is limit the liability that might occur at one store from rippling out to other stores. And so the zero strike put or limited liability does in fact have significant economic value. Otherwise, these companies wouldn't pursue it. Multiple risk factors. If you think about the chief risk officer's task, is you want to identify the key set of risk factors, You want to map each balance sheet item to these factors. Well, ABM is well suited for this. If you think about the change in equity of a company as being dependent on multiple factors, say balance sheet items, or you could just think about a common stock and it's a function of, say, beta and the PE ratio and momentum and other factors, Fama-French 3-factor model, or with Carhart's adjustment 4-factor model. We can model these factors separately. Well, ABM can easily handle this. GBM's not well suited because summing a sum of log normally distributed random variables is not tractable. And so multi-factor ABM-based stock value that we just discussed, this is easily the sum of normally distributed variables is log normal. So the diffusion process of the portfolio is a normally distributed diffusion process when every stock is normally distributed. And so you can easily roll up and roll down between the individual risk items and the stock, or the individual stocks in a portfolio and the value of the portfolio itself. The Greeks will cover this later in modules where we cover the option Greeks, and it's based on empirical observation. The crash of 1987, the Black-Scholes-Merton suffered a permanent loss of confidence. Something known as the implied volatility surface emerged, which means there's not a single volatility that describes the underlying volatility. There's only one underlying volatility, but implied volatility suggests there are many, which is a problem. And there's really no unanimity of opinion on best model. So the best model is one that leads to the best decision making, and that is governed by the judgment of the chief risk officer and their team. And so I would rather have multiple models to be able to appraise which one works best in my circumstance. To understand whether we should be modeling risk as relative or absolute, relative risk is the GBM-based model. Absolute risk is the ABM-based model. Consider the following situation where a stock falls from $100 down to $50. If that fall was based on bad news, the relative volatility of GBM implies lower absolute risk. And that seems counterintuitive to me, that if the stock price gets cut in half due to bad news, it is obviously a more risky company, and I would want the absolute level of risk to go up, not down. If it falls based on bad news, the absolute volatility implies higher relative risk, and that makes intuitive sense. If there's a 2-for-1 split, the relative volatility automatically handles this, and the volatility remains the same. The absolute volatility, you have to manually go in and divide by 2. Yes, that's a bit cumbersome, but it's not insurmountable. GBM ignores the leverage effect that Black-Scholes discussed in their 1972 paper. The ABM automatically incorporates this leverage effect. And so with regard to addressing leverage, ABM, in my mind, seems far superior. Extreme volatilities, we covered this in one of the late modules in Chapter 3, but the log normal distribution just really goes crazy with high volatility. The mean explodes upward, the mode explodes downward, the median stays the same. With the normal distribution, mean, median, and mode are all the same. And high volatilities results in unstable log normal distribution. I've actually done some consulting work in this space, and for high implied vols, the GBM option valuation models are just not workable, and you have to have something else. Options on electricity is a good example where you can run into some severe problems. When we come back in part 2, we'll pick up this discussion looking at the question of binomial convergence.